Hi, my name is Abdul Mustaki. My matrix number is 103056 and I'll be presenting the introduction. A financial analysis of two major companies on Bursa Malaysia, which is Petronas Chemicals and Petronas Gas. While both companies are important to Malaysia's energy sector, they use very different financial strategies to succeed. Petronas Chemical is a growth company. They invest heavily in making chemical products and sell them to the world, which means their profit change whenever global oil price go up or down. To manage these risks, they focus on keeping a lot of cash and staying flexible. On the other hand, Petronas Gas is a stability company that acts as a backbone of Malaysia gas pipelines, using a long-term contract and government rules to ensure their income steady and predictable. Instead of taking big risks for growth, they focus on being reliable and paying regular dividends to their shareholders. In our report, we analyzed 5 years of data looking at their profit, debt, and cash flows to see how these two different models perform. Finally, we use financial tools like WSCC and capital budgeting to give strategic recommendations for the future. Our global is show that there is no one size fits all rule in finance, as strategies must change depending on whether a company wants fast growth or stability. Thank you.
Looking at our first chart, we see two different stories. Petronas Gas shows great resilience, recovering to a strong 2.40 times in 2024. However, Petronas Chemicals has seen a steady decline from 5.09 times down to 1.68 times. If you look at the table below, both companies remain in the healthy zone because they are well above 1.0 times benchmark. While PCG's buffer is shrinking, PGB's position is actually strengthening as of last year. Now, we dig deeper. The quick ratio shows that PGB is extremely stable at 2.38 times, while PCG relies more on inventory, sitting at 1.31 times. The real difference is the cash ratio. Petronas Gas has a massive cash buffer of 1.71 times, meaning they can pay all debts with just the cash in their bank. Petronas Chemicals has tightened to 0.89 times, so they now rely more on collecting money from customers to meet immediate bills. To wrap up, both companies are currently solvent and safe. However, Petronas Gas is the clear winner in terms of resilience, offering a much higher margin of safety and a stronger cash position compared to the tightening trend we see in Petronas Chemicals. That's all from me, thank you.
Petronas Chemical Group berhad highly volatile. Gross profit margin and net profit margin surged in 2031-2032, high product price back collapse in 2033, low price or high cost. Management prioritized risk hygiene and inventory management to cushion against commodity price fluctuation. The low 2033 net profit margin signal the needs are aggressive cost rationalization and a strategic product mix shift toward higher margin special price. Petronas Gas very highly stable and high gross profit margin is consistently near 50%. Net profit margin is consistently high near 28 to 33% but show a mild slow decline. Management relies on this stability for predictable returns. The mild net profit margin decline requires focus on controlling non-operating expenses such as financing costs, administrative overhead, and ensuring tariff rates under the regulated assets-based model are sufficient to cover rising costs. Comparison, Petronas Gas berhad maintained a significantly higher and more stable margin due to its utility-like service contract, gas processing and transportation, while Petronas Chemical Group berhad margin are highly sensitive to global petrochemical price. That's all. Thank you. Next, I will explain about return on asset. Analysis Petronas Chemical Group berhad. The return on asset for Petronas Chemical Group berhad is highly cyclical, tracking profit volatility closely and peaking significant in 2031 and 2032, before dropping sharply to 3.11% in 2023. From a managerial perspective, this drastic decline indicates that capital utilization efficiency has worsened in the short term due to external market factors. Consequently, management must strictly evaluate the efficiency of new capital expenditure and monitor for potential asset impairment to ensure that the company's massive asset base is still generating adequate value. For Petronas Gas berhad demonstrate a much more stable profile, although it shows a mild and sustained decline in its return on asset. This suggests that while the total asset base is increased due to continuous infrastructure investment, these assets are not yet yielding a proportionally higher return. Management must focus on long-term capital efficiency by ensuring that all new investments remain aligned with the regular return model and are delivered strictly on budget and schedule to prevent further erosion of asset return. It's time to explain about return on equity. Analysis Petronas Chemical Group Berhad. The return on equity for Petronas Chemical Group Berhad is characterized by extreme fluctuation driven by market cycle. While the high return on equity during boom years support large dividend payout, the subsequent sharp drop highlight the company vulnerability to global price change. For shareholders, this means that while the potential for high return exists during market peaks, the risk to equity value is significantly higher compared to more stable industries. Petronas Gas Berhad. In contrast, Petronas Gas Berhad offers a steady and predictable return on equity, moving slightly from 10.58% to 9.73%. This consistently make the company an attractive defensive stock for investors who prioritize predictable return and stable cash flow. Management support this stability through a disciplined capital expenditure approach and a reliability dividends policy, ensuring that shareholder equity is protected and rewarded consistently despite the slow decline in overall percentage.
Overall, Petronas Chemicals maintained a conservative capital structure. It consistently held more cash than borrowings, meaning net debt was negative, and interest coverage stayed high at 15 to 30 times. This reflects strong liquidity and a cautious expansion strategy. Petronas Gas, on the other hand, used debt strategically in the early years to benefit from tax shields, but shift to deleveraging after 2022 to reduce financial risk and maintain flexibility. Looking at debt to assets ratios, Petronas Chemicals moved from 0.16 to 0.22, showing a slowly increase in debt finance assets. Petronas Gas, however, remained stable around 0.18 until 0.19 until 2022, before falling to 0.10 in 2024. This indicates that more of its assets are now backed by equity rather than debt. Overall, Petronas Chemicals maintained a conservative capital structure. It consistently held more cash than borrowings, meaning net debt was negative, and interest coverage stayed high at 15 to 30 times. This reflects strong liquidity and a cautious expansion strategy. Petronas Gas, on the other hand, used debt strategically in the early years to benefit from tax shields, but shift to deleveraging after 2022 to reduce financial risk and maintain flexibility. In conclusion, both companies demonstrate prudent financial management but with different approaches. Petronas Chemicals adopt a steady equity-heavy structure to remain resilient in the volatile petrochemical industry. Petronas Gas, operating in regulated utility sector, moved toward a more conservative financing policy to ensure stability under regulatory constraints. Together, these strategies highlight how capital structure decisions are shaped by industry dynamics and long-term sustainability goals. That's all from me. Thank you.
The PE ratio graph shows that Petronas Gas steady at 16 until 20, reflecting consistent investor confidence. Petronas Chemical, however, swings from 9.7 in 2021 to above 35 in 2024. This highlighting exposure to global demand cycles. PGB's regulated utility models make it defensive with stable returns, while PCGs offer cyclical growth but higher risk. The dividend yield graph shows that Petronas Gas steady at around 4% after 2021, offering reliable returns for income-focused investors. Petronas Chemicals, however, fluctuates between 3.3 and 4%, reflecting profit cycle sensitively. Overall, PGBs is dependable choice for conservative investors, while PCGs offer cyclical potential but with more variability. These 5-year trends highlight the contrast between Petronas Gas Berhad and Petronas Chemical Group. PGB shows stability with its PE ratio consistently between 16 and 20 and dividend yield steady at around 4%. This reflects predictable performance and strong investor confidence. In contrast, PCG demonstrates volatility with PE swinging from 9.7 to above 35,
and dividend yield fluctuating between 3.3 and 4%. Overall, PGB represents a defensive investment with valuable income, while PCG offers cyclical growth potential but a higher risk.
Moving into Section C, we will evaluate the investment viability of boards firms. We use two primary financial tools, which is WACC and NPV, to determine not just what this company have done, but what they should do next to maximize shareholder wealth. By calculating the WACC, we establish the minimum return required by our investors. To understand our decision making, we first look at the WACC. As shown in the chart, Petcom's cost of capital is significantly higher at 7.22%. This acts as a hurdle rate, which is any project Petcom takes on must earn more than 7.22% to be considered successful. Petgas has a much easier path with a lower hurdle of 3.57% due to its stable utility nature. We then use this to discount our cash flows through an NPV analysis under three different market scenarios, which is best, expected, and worst case. This allows us to see exactly how sensitive these companies are to global economic shift. This scenario analysis is the core of our financial evaluation. While both companies show positive value in an expected year, the disparity in risk is clear. Petgas remains safe even in a downturn, but Petcom faces a massive value destruction risk if market conditions worsen. This proves that Petcom's management cannot rely on market luck. They must have strong financial defense. In this section, we examine how the strategic choice regarding financing, investment, and dividend distribution directly shape the risk profile and the value creation potential of both Petgas and Petcom. On financing part, as we see in the pie charts, both companies maintain a very low debt to equity ratio. While this provides financial flexibility and safety, it also means the companies are not fully utilizing the interest tax shield. For a stable firm like Petgas, this conservative stance actually keeps their WACC higher than it will be if they incorporated more low-cost debt. On investment part, management investment policy directly impacts the NPV we saw earlier. Petgas focus on long-term utility assets, which results in a tighter range of NPV outcomes. Petcom's management, however, choose to invest in global specialty chemicals. This leads to higher potential rewards, but as our scenario analysis show, it also exposes the company to massive downside risk during economic downturns. On dividends part, finally, the decision to maintain high dividend payout suggests that management is confident in their cash flow. However, from a financial management perspective, every ringgit paid in dividend is a ringgit not reinvested to the business. This forces both firms to rely on external markets if they want to fund massive new growth projects in the future. Our first recommendation targets Petgas. Because they have such a stable business model, their 95% equity structures is actually too safe. By moving towards a more balanced debt ratio, they can utilize interest tax shields. This would lower their hurdle rate even further, making more infrastructure project viable and increasing the wealth of the shareholder. For Petronas Chemicals, the priority is not of the capital, but the volatility of the market. To prevent the massive loss we saw in our worst case NPV model, management must use financial derivative and hedging. By locking in prices for their chemical products, they can floor their revenue and ensure that even in a global downturn, the project remains in positive territory. Finally, both firms should look at their internal operation. By improving their cash conversion cycle, which is essentially getting paid faster by customer and managing inventory more efficiently, they can increase their free cash flow. This provides a buffer that allows them to fund growth internally rather than relying on expensive external financing. By implementing the three pillars, which is optimization, protection, and liquidity, Petronas can ensure that both subsidiaries are not just surviving the current market, but are financially engineered for long-term growth. To conclude our entire report, we have moved to beyond the historical ratio to look at the future of these two industry leaders. Our finding is that being debt-free isn't always the most efficient choice. For Petronas case, we recommend moving towards a more balanced capital structure to capture tax shields and lower their hurdle rate even further. For Petronas Chemicals,
the priority is shielding. Our NPV model revealed that a single bad year in the commodity market could destroy nearly 815 million in value. Therefore, they must prioritize aggressive hedging to stay in the green. Ultimately, while both firms are stable pillars of the Malaysian economy, their paths to maximize wealth are different. Petgas must focus on efficiency, while Petchem must focus on resilience. Thank you.